Hello everyone, thank you for tuning into this video today. My name is Nick Strobelt with Avalon Wealth. By this point, you've likely made some significant steps towards preparing for retirement, or possibly you've already made the big transition and retired from your full-time employment. The whole goal, of course, of retirement is to have your passive income be greater than expenses with as little stress as possible. And so typically when we look at a retiree's portfolio on an ongoing basis, we see three major categories that their investments are in. Those categories are recommended by different professionals, depending on the organization that someone got their advice from. And those major categories from a blimp level view are 1, safe investments, 2, risk investments, and 3, a hybrid category that takes some components from risk and safe. And so let's take a look at each of those categories a little bit more in depth so we can see some of the pros and cons of those categories and see why it may be appropriate for someone's portfolio or why it may not be appropriate for someone's portfolio. So let's dive in a little further. In the safe category, we have checking accounts, also savings accounts. We have money market funds. We also have government bonds. If you can think of treasury bills or treasury bonds, those are definitely in this category. We also have something called a fixed annuity. All of these strategies have some similar components. They have in common that they are fixed, meaning that there's a interest rate that you agree upon before you enter into the product that would last for the duration of that agreement. The second thing that they have in common is protection. The principal put into each of these investments is protected. In some cases, checking and savings and money market funds. If you're part of a FDIC insured bank, it's up to $250,000. Government bonds, T-bills, T-bonds, those are insured to the full faith and credit of the US government. Fixed annuities are also protected from, the principal is protected, and it cannot be affected by market volatility. The third component that these have in common is they have a term. There's an agreed upon time frame that someone has to agree upon before they enter into a T-bill or a fixed annuity. Checking and savings accounts, usually there is no term, but CDs do usually have a term. The rate of return for this category ranges pretty on the low end, between 0 and 3%. You're not taking risk, so you are on the low end of the spectrum for returns. On the other side, on the different category, we have a risk category, which are stocks, ETFs, mutual funds. We also have commodities in this category: gold, corn, cotton grain, oil, things of that sort. All of these things share common attributes as well. The common attributes are potential interest, they are liquid. You can pull the money out anytime you like. And the third component is they have risk. The money you put in is not protected against market volatility. They can go up or down depending on the market cycles. The rate of return for this category over long time horizons, over many decades, has been traditionally between 6 and 10%. However, during large market swings on the upside and downside, and those who have lived over the past 15 years have seen a few of those take place, we can typically see in a bad market cycle the broad index fall as much as 50%, and in a good market cycle it can rise as much as 50%. But over the long horizon, 6 to 10% is more of the range that they are in. Now, of course, this is not a linear strategy whatsoever, so the market returns are going to go up and down. I like to look at it if you imagine this cycle, markets have their up and down cycles. Over the long haul, over decades, it goes in the upward direction, but over any short time period, it can be up or down over a few years or more. During someone's employment years, when they're contributing to their retirement accounts, the 401ks, IRAs, and other brokerage accounts, if someone's making regular contributions, that's dollar cost averaging. Someone is making small contributions into their account over all market cycles. And this is a good thing, because what it means is when markets are going down, then you are still buying low. And then when markets are going up, you're still buying in. No one can time the high because market timing is an impossible ability, but we continue to buy in along the way. So over time, we buy the average of the market as it continues to grow. And that's a great thing during the working years. However, the biggest transition that takes place is after retirement, when our time is up, so to speak. Meaning we are no longer have the ability or maybe the desire to go back to work and earn a living. And so now we are reliant on what we already have saved to support us for the rest of our life. And so in retirement, the opposite is true. Instead of dollar cost averaging, we have reverse dollar cost averaging, where over market cycles, someone that is invested in this category that has these attributes would be withdrawing money from all stages of the market cycle. Now, as you see, when markets have their downward cycle, if someone is withdrawing money from their account during that point, they are violating one of the biggest rules that money managers suggest, which is do not sell low. But through a strategy like this, often people sell low in order to support their income needs during retirement. And so it is a potential downfall to many retirees who potentially can run out of money before they would like to. Or in other words, they outlive their money and have to find alternate means sometime during their retirement years, which is a thing that we all want to avoid. And so this is a risk category that has some very different attributes to the safe category. But now is a good time to talk about a third category, which is the hybrid category. The hybrid category borrows some attributes from both of its cousins. One of the products or strategies in the hybrid category is something called an equity linked CD. Equity CD has attributes of a traditional CD, but it's linked to a market index, so it has some upward potential that may be greater than a traditional CD. Also in this category are Treasury inflation protected securities. These are government issued bonds that have an inflation protection component in them. So if inflation is higher than normal, the interest you receive would be greater. So it's a way to hedge your inflation. Another category in this hybrid section is something called a fixed indexed annuity. Now, annuities have lots of good and bad said about them, but this particular annuity is in the hybrid because it shares components with both the safe and the risk category. So let's talk about those. So the components that it shares is it borrows the fixed out of the safe category, meaning that the principal invested into these accounts is protected. It cannot decline if you hold on to the product. Also, it borrows the potential interest from the risk category. So it has the potential to increase in value if the markets go up or doing well, which is a great thing. It also borrows from the safe category, the term component. The typical rate of return for the hybrid category is anywhere between 0 and 10%. Now that's a very broad, wide range. It's not always those things. It can be definitely 0, it could be more than 0. But on a traditional years, it is more likely to stay in the range of 3 to 6% on average per year. And so the benefit of the hybrid category is you get the benefits of principal protection, but you also get more upward potential of market interest if markets do well, which is a great fit. Because one of the primary purposes of retirement planning is to create a strategy and portfolio so that passive income is greater than expenses, it is important to be very purposeful in someone's retirement planning. Often when we do reviews and analysis of different portfolios, we see heavily weighting in the risk category or in the safe category, either one or the other, or a off-balance mix that doesn't really have a purpose and a strategy for creating the most passive income that can generate income for life. And so when it's time for you to sit down to discuss your retirement planning, there is an optimal scenario that can take advantage of all categories to ensure that income can last for the rest of your life and provide that peace of mind that is so important for many retirees. We want to reduce stress and anxiety as much as possible in retirement, and so that we can enjoy the best years of our life. When you're ready to make those steps, please give our office a call at Avalon Wealth. Thank you.